Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into today's discussion, I'm very pleased to tell you all that we now have our very own Bondcast channel. So if you want to keep getting the latest episodes of Bondcast straight to your ears, head over to Apple Podcasts, Spotify, or wherever you listen and search for Bondcast, the Rates Podcast, and hit subscribe. All right, Theo, I'm going to start with you this week because I think the UK is probably where it's been most exciting, or at least we've seen a lot of volatility over the past week. But before getting into what's really been driving that, I just wanted to quickly touch on green bonds, because I know one thing that we've been talking about, aside from the whole inflation discussion, is the UK's green gilts. And we should be getting a new green gilt in the next couple of weeks. So I was wondering if you could just give our listeners a kind of quick download on everything we need to know about that upcoming green gilt issuance.
Yeah, thank you very much, Imogen. So green gilts is a key theme for UK issuance this year. 15 billion pounds have been allocated for the issuance of green gilts. The first deal has gone really well. We talk about 10 billion that were sold, and the book size was at 100 billion. Just to give some context, we've not seen a book size of 100 billion ever. So it is a record. Also, the transaction and the gilt seems to have been trading well right after that. So there was clearly very strong demand for that short-dated, or let's say 10-year green gilt. And now the DMO considers issuing a 30-year green gilt, as you've correctly mentioned. Yeah, indeed, on the 19th of October, it's our estimate we should get 5 billion of a new 30-year green bond. So the DMO, they are building up the curve. They're building up the green curve. And obviously a second bond is needed. Now the investor base is different for the short-term dated, because a 10-year bond, well, it's shorter. It's hard to argue that it's just short. The investor base is different. For the 10-year gilt, we've seen internationals, real money, bank treasuries, quite a wide investor range. For the 30-year bond, the investor base will be different. It will be more pension schemes, more LDI related, and also UK real money. Now, we'll wait to see how that transaction goes. We think that it should be very well received. The level of yields in the UK look appealing. On a cross-market basis, also, the UK seems to be an attractive market right now. So we think that this transaction will go well. It is something where we should get at least a set 5 billion. Maybe we get more. But really, this is something that we need really to assess. What I think matters here is that the DMO, they want to have a liquid, deep, stable market, well-functioning market. So those things, rather than just impress with more bonds and with more size. So this is why I think that it will go well. But we need to assess how strong it goes and then think what the next steps are with regards to green issuance, which seems to be an exciting topic in the UK.
I guess with those last couple of sentences, you really sort of answered my next question, which was going to be, the DMO said at the beginning of this year that they intend to do at least 15 billion of green gilt. So we've already had the 10 billion of 10-year in September, and now we're thinking of getting, around or at least 5 billion. Do you think that they probably stop there with kind of green issuance for this fiscal year then and look to return to it next year? Or do you think that if next week does go well, then there could be the possibility that we see perhaps a third new green bond from the DMO this year?
I think there is a difference between willingness to issue and then the need to issue. So on the 27th of October, we'll get the update of the budget. And that update will include forecasts with regards to CGNCR, or cash numbers, or fiscal numbers, and how much in terms of gilts will need to be issued. And we do expect a revision in terms of gilt issuance. Now, is it 30, is it 40, is it 50 billion? This is something that we are still working on, but it will be a sizable revision. That means that we'll get less of everything, less short-dated conventionals, less mediums, less longs, less linkers, and probably, the scope to get more green after that becomes smaller, at least in this financial year. Again, we cannot exclude anything, and maybe demand is really so strong on the 19th of October that the DMO issues well beyond those 5 billion, right? But I think that for this financial year, most likely the need to raise cash will be smaller because, well, the UK economy is rebounding actually better than expected. So we've got good news for that. But it is something that we do expect to be a key topic in the next financial year. So green issuance is something exciting, is something appealing, and it will keep us busy for the next years.
I think it certainly is, and it's going to be a busy month anyway for green issuance, because we also have next week the first green syndication from the EU as part of their NGEU funding. So October is set to be quite a big month on the green bond front. Okay, let's move on then to more exciting things on the inflation front, which we've already kind of alluded to in the pod. There's been a fair amount of volatility, I would say, in the inflation market in the UK. So why don't you just give us your latest thoughts on that since we spoke last week, because there's been a fair amount of movement.
First of all, what we do see is that the disruption is clearer, much more evident in the euro area. Euro area means, Europe and the UK. So what I call Europe, I still assume that the UK, even though with Brexit, we are part of Europe. So in Europe, it is clearly much more evident than in the US. Yes, there is a rise in commodities, but this is a lot more evident. To put things into perspective, I mean, we talk about 1 month increase in the euro area, and the UK, which is of around 125% in natural gas prices, whereas in the US, this is only 34% as of now. So clearly the magnitude is different. What does it mean? Well, a lot of investors try to mark the front end of the inflation curve on the back of that. The very short end of the curve, the 1 year, is extremely volatile. We talk about intraday moves in the area of 50 to 20 basis points every day. Some prints this year, some prints today for next year, for example, for April 2022, the market price was pricing in at some point earlier today 7.2% of an RPI rate, which is unprecedented. We've not seen that since 1990. So even maybe some of our young members and in the audience, they may not have been around at the time. So we talk about very, very high numbers. We talk about uncertainty. We talk about volatility. We talk about gap risk. Now we're recording on Wednesday, the 6th. What we see is that there has been a correction in commodities later this day, intraday. So really, it is a fast-moving market. I talk about the last 3-4 hours, and that correction now has brought sellers into the market. What I find very interesting here is that even though this, in theory, it should be a weaker short-end inflation story, what we see is that the market just prices in all inflation a bit cheaper because the market is so scared to sell front-end inflation. It is something that the market did several times, and it becomes a bit of an anecdote, a bit of a joke, and there is the jocularity with regards to that. What have you done? Have you sold inflation? And it keeps going. So we see that there is, despite that correction, that there is a lot of fear in the market, and we think that this is actually justified. So this is why, in our view, from a directional point of view, probably investors should be fairly neutral, simply because that volatility may persist, or if they want to have any inflation views, they should try and hedge with commodities, with oil and natural gas.
What is this, I guess, volatility in the inflation market and people's sort of changing expectations around future inflation? What has that meant for rate hike pricing in the UK?
I think we need to put things into context, and we've had over the last 2 weeks 1 year inflation expectations pricing higher by around 50 basis points, and there's been a repricing higher in terms of hikes. Now this is smaller. This is lower than what you would expect in a normal environment, because a significant part of that is energy inflation. But there is indeed a lot of traction with regards to paid positions. So there is significant appetite from investors to go with the theme, to sell fixed income to pay the front of the curve. But what I find very interesting is that more and more discussions come up with regards to a potential policy mistake, which to me, this is very significant, i.e. the market thinks that, yes, there may be hikes coming up, but this is not with a strong economy. This is just because the inflation risks need to be controlled, which probably will have to be negative for other asset classes. I mean, we see equities, for example, being particularly weak. So long story short, yes, there has been some paying at the front of the curve, but we also think that, it is different, and it will be a very different hiking environment than, say, if we had a strong hiking cycle, as it would have been during other circumstances.
That makes sense. Thanks, Theo. So sort of sticking with the inflation discussion, but moving over to the euro area then, Giles. I want to ask you something that's kind of increasingly coming up in our conversations, certainly around the office, but with clients as well. And I know both you and Jan are going to groan when I use the word, but how do you feel about stagflation? Is that where we're headed now, or is that not your base case at all?
Well, it's not our base case by a long way, to be honest with you. Growth is pretty strong. Our forecasts are for much higher growth than we've seen in recent years, because there's still a significant gap to fill between where we are in terms of total activity and where we were before the pandemic. And so I think that the idea that we are headed for a recession or anything like that is obviously a fairly sort of distant tail case. I think most people accept that, and what we're really talking about is the risk of slower recovery growth, but with more inflation in the mix. And so I suppose we have to think a little bit about what that means for the curve, and what it means for central banks, and what it means cross asset, because obviously that then feeds back into rates markets. And so we've had a lot of questions around that subject, and to be honest with you, it seems to me like there's quite a lot of confusion as well.
Well, hopefully we can dispel a little bit of that through Bondcast. Now, sticking with inflation then, because this week you've been doing a survey to our kind of corporate clients and asking them about their sort of expectations around the future path of inflation, I suppose, and what impact that's going to have on their corporate decision making. I was wondering if you could just share some of the interesting takeaways from that survey with us.
Yeah, by all means. Before I do that, I'm just going to go back on this question of the confusion and so on that I was just alluding to, because I think it is important just to say that essentially, I mean, you already heard from Theo that there's this question of is there going to be a policy mistake of some kind? And to be honest with you, that can cut both ways. I mean, a policy mistake could be the kind that allows inflation to let rip, and it could be the kind that actually just pushes us, as a result of this higher inflation and all these constraints on the supply side, into a much slower growth, possibly even recession. And then that it turns out to be what kills inflation, and we just get shoved back into a low inflation kind of trap. And so when people are thinking about what this means for rates, I mean, obviously at the moment, inflation break-evens are roaring, to be honest with you. And so, that's one market which has made its view pretty clear. And in fact, this morning, now I'm very pleased to see it's come back now a little bit, but we actually reached 1.85 on the five-year inflation swap, which is a long-term target that I had. We didn't take that off. My bias is to see that going higher. But for me, the only way to trade this is a curve steepener, particularly in Europe. And I mean, I'm actually surprised that there's this level of confusion. I mean, I completely understand that markets leap ahead to the ultimate conclusion where where the path ahead is an obvious one. But at the moment, I don't think that most people would reasonably conclude that we're headed towards a stagnation, a significant stagnation, recessionary type environment. I think that it's much more likely that what happens is that we end up with less QE and central banks just playing it a little bit defensive on rates, and so that's going to allow both the flows and the expectations to kind of steepen up the curve. So that for me is absolutely clear conclusion. Okay, on your other question, the survey. So this was mostly of UK clients, and I think it was interesting because it was aimed at mostly sort of small and mid cap corporates from our the client base from our wider bank, and we're going to discuss again in a written note with more detailed conclusion. So if anyone wants to get into that, look for that, or they can always reach out to us if they have a relationship. But the conclusion was very clear that firms think that this period of higher inflation and cost pressures is in the main is going to continue until well into next year, towards the end of next year, or a lot of people are saying, I'd say about a third of respondents are saying that it's going to continue into 2023. So it's going to be quite prolonged. And they seem to be quite positive about their pricing power to deal with that overall. So this idea that at least UK PLC doesn't have any pricing power is doesn't seem to be borne out, at least by this survey. And I would say that that's also reflected in business surveys of I guess manufacturing in the US, and a lot of anecdotal stuff out of the euro area as well. So if you're thinking about what the likelihood of a perpetuation of this through expectations and price setting, well, I think this is something that you should be taking seriously.
All right, thank you, Giles. Moving away from inflation slightly then, Jan, and over to the US, where the key, I guess, focus this week is going to be payrolls on Friday. Now, I will repeat what Theo was saying, is that we are recording this on Wednesday, but probably not likely to come out until Friday. So most listeners may have the luxury of knowing what that payrolls number is. Unfortunately, Jan doesn't. So without getting into too much detail, I suppose, on what our forecast is for this inflation, for this payrolls number, sorry, I guess the most important question here is really, what number will we be looking for to change the course for the Fed's taper? Or is that really not, is it going to have to be extremely weak for them to really be thrown off their current taper timeline?
I think that's right. Looking into our crystal ball, I guess, and on Wednesday, we have slightly below market consensus, somewhere around 400,000 jobs. And we were thinking that even with that, that will be well above the Fed's comfort limit of let's go ahead. And just for reference, the consensus at the time of recording was about 500,000 jobs. So we're still about 100,000 below where the market sees it. And we think that is a decently above the threshold that Chairman Powell and the committee would be comfortable to go ahead with tapering. There's a couple of caveats, and now I actually have the privilege of seeing the ADP numbers, which came pretty strong, and they're not always perfectly correlated with the non-farm, but we did get a good print just before the recording. There's of course going to be a couple of other little, I don't want to say kind of like scapegoats, but reasons why the Fed could even look past below our forecast jobs number. First, we had Hurricane Ida. National readings have been a little bit muted, but you could still see that spilling over a little bit into the September jobs number. The other thing is the August numbers usually have the tendency to be revised higher. So if we see the really weak print going up by say 100,000 jobs, then in reality this month's forecast didn't even have to be 400,000. It could have been just all else equal 300,000 makes the same change. So while we're still below what the pre-COVID employment levels are, I think I think unless it's a really, really disastrous print, the Fed will be fine to go ahead in November. I don't have a specific number to keep in mind. It's going to be very subjective, and I suppose how the market reacts to it, but it has to be, I think, very, very weak to stop them.
Yeah, I think that sounds about right. So away from monetary policy, then last week we spoke a lot about the fiscal side and what's going on in politics, and well, there's loads going on. So perhaps you can just give us an update on the kind of latest happenings over the past week, because there was a lot to talk about last week.
Yeah, and I promise I'll keep it much shorter this time. But so this week, the main development was the White House sort of intervention into the negotiations. So we heard from President Biden, who sort of came in and went to the progressive side of the Democrats, saying this $3.5 trillion package is not going to work out, it has to be smaller. On the other hand, the suggestion was something about 1.9, 2.2 trillion. On the other hand, the centrist Democrats, I'm talking like Senator Manchin and Sinema, they're kind of looking more like a 1.5 trillion figure. But earlier this week, after President Biden's remarks, Senator Manchin came in and said, 1.9, 2.2 is actually something I'd consider. So it sounds like they're reaching a middle ground for this Democrat-only reconciliation bill, which would have the social packages. It obviously will have to be trimmed a decent amount because of the reduction in size, but it's kind of in line with our base case of 2 trillion of new spending with some 1.5 offsets. So it looks like that's happening. Although the biggest gridlock now is the whole debt ceiling debacle, which we're still in the middle of. Today's Wednesday, so they will have another vote in Senate, but that probably will be blocked again. It won't happen. So we're just not seeing a way that the debt ceiling issue gets resolved in a partisan way, but rather it will eventually have to go through a reconciliation process, which is a little bit slower and kind of more tedious and more complex. And it's only has to come from the Democrat side. But to me, it just feels like this is going to get dragged out till the very last moment.
With that 2 trillion package, then that's our base case. Is that close to what you would say market consensus is for that number? And if it does turn out at, say 2 trillion, how does that impact or not impact our supply outlook into the rest of the year and beyond?
Right. I think it's in line with market consensus, more or less. And of course, that 2 trillion has a lot of it in tax increases and other sorts of offsets. But the thing is, and it's important to keep in mind that Treasury is really, really overfunded right now with the current pace of issuance. And even with tapering, assuming it starts in November, we think we'll see a reduction in coupon issuance from November onward, announced to November refunding. So now they're about 1 trillion, almost 1 trillion a year overfunded if they continue with this pace in coupon issuance, it has to be trimmed. Of course, these packages, say the partisan and the bipartisan, if they have about 1 trillion of new spending combined, and that's spread almost over a decade, that really doesn't move the needle that much compared to what the Treasury is issuing right now. So I don't think it really makes a big difference in the trajectory in the near term, especially. I think what eventually would end up happening is that Treasury has to just cut slightly less, but at this stage, like I said, they're well overfunded.
Okay, great. Thank you, Jan. Well, I think that's probably all we have time for today. So thank you everyone for joining me. And just a reminder that we now have our very own Bondcast channel. So if you do want to keep getting the latest episodes of Bondcast straight to your ears, head over to Apple Podcasts or Spotify or wherever you listen and search for Bondcast, the Rates Podcast, and hit subscribe. Thank you. Speak next week.